We hear a lot about the fact that M&A dropped off, as we know, from those record numbers back in 21. Are they coming back?
We're certainly beginning to see a significantly greater amount of activity. It hasn't manifested itself yet in announced transactions, but announced M&A for the first 6 months of the year was down. The dollar volume was down 40%. I don't expect it will be quite as bad in the second half of the year, but certainly the amount of dialogue among our clients is up quite dramatically, and our backlogs are up.
A big change from 21, for example, is interest rates.
Yes.
I mean, the Fed has been adding interest rate basis points as fast as it could. How does that change the nature of M&A going forward? I mean, are they going to look different, the deals that you do?
Well, it does. It unquestionably affects the amount of leverage that you can put on a transaction. And that, of course, affects the private equity firms, particularly, not as much industrial companies, because they're all, or many of them are investment grade rated. And ultimately the banks or the lenders, which are increasingly non-bank, calculate how much debt a company can support by some measure of interest coverage. So when rates are up, that limits somewhat the amount of debt that a private equity firm can put on a company. However, they also look at the way a mortgage is done. What's the amount of loan to value, a traditional loan to value analysis, and that doesn't really change that much. So it's a balancing act between interest coverage and the fact the loan to value analysis.
You mentioned private, particularly private credit. To what extent is private credit really taking up the slack right now, particularly as banks feel they may need to pull back some? Well,
there was a period probably 5-6 months ago when almost all leveraged loans, all leveraged buyout transactions were financed by private credit. And by the way, that's not a terrible thing because they're separated from the deposit insurance function, and so that's taking actually credit risk out of the banking system. So there's probably $1 trillion of private credit balance sheet out there, and so that's become a significant competitor for the banks, but that's probably a healthy thing for the financial system.
What is the shakeup, if I can put it that way, in M&A doing to the investment banking business itself? Because we saw Credit Suisse now is really, obviously, essentially pulling out of the business entirely. Goldman Sachs has been laying off bankers. Is it changing the personnel situation for a place like Evercore?
Well, the interesting thing is that, advisory, M&A, restructuring, but M&A obviously being the biggest part of it, is almost our only business. We have a research business and we have an underwriting business, but at their peak, they were maybe 14-15% of our revenues. So the vast majority of our revenues come from advisory. Goldman Sachs, which has the largest advisory business, advisory is about 5% of their revenues. So it's the most prestigious part of their business, but it's not something that dramatically affects the profitability of the business, although when you put it together with equity underwriting and debt underwriting and other things, that's not great for Goldman Sachs. In terms of our business, our growth comes from adding A+ and A talent, and we just announced our earnings yesterday. We've had a record number of very, very talented, what we call senior managing directors, which is our most senior title, join us or commit to join us in the first half of the year. So disruption in the large firms, causes people to stick up their head and say, gee, do I want to be in a place where what I do is the core business of the company rather than 5 or 7% of revenues? And in the case of places like JP Morgan and B of A, they're so big, still important, still prestigious, but it's a very small part of their revenues.
Let's talk about regulation for a second. There's a lot of talk, has been since the beginning of the Biden administration, about antitrust enforcement. And now we've just had new proposed merger guidelines come out, which are decidedly more restrictive, particularly involving private equity potentially. How much of a chilling effect is that having on businesses as they think about mergers and acquisitions?
Yeah. Well, I think I may have been asked this a couple years ago when the appointments were made to the FTC and the antitrust position. And I said that there definitely will be a more aggressive enforcement, but for it to actually dramatically limit activity, there would have to be law change in Congress, and I was very skeptical about that happening. That has not happened. It's not going to happen in my view. So we've gone through a cycle, in my view. You've gone through a period where there's been more enforcement, more second requests, more challenges to transactions, and some of those transactions companies chose to not proceed because they didn't want to go through the pain of contesting the FTC or the antitrust divisions contesting. Now we've seen 2 or 3 or 4 instances where companies have said, you don't really have a basis in law for challenging this merger, so we're going to go to court. And their record in court has not been great because the law hasn't changed. And so now what you're hearing a little bit more from clients is, I recognize that this will probably be challenged, but let them take me to court because we'll win.
But it must increase the friction costs. It
definitely
might take longer, it'd be more expensive, you have litigation you have to pay for. So is that a deterrent at all? Or
it is.
Do people just blow past that?
It raises the bar, but if the bar went up because of the challenges 6 or 8 or 10 months ago, it's now come down a little bit because they've lost in court, and challenging them legally has become a more accepted practice.
So finally, Ralph, let me ask you to look in your crystal ball here about mergers and acquisitions. We started this by saying it's down 40% year over year for the first half of the year. You think it'll be somewhat better if you look at the entire year. If in fact the Fed, and we don't know what the Fed's going to do, if the Fed actually holds where it is or maybe only goes up 25 basis points, and then some point next year starts to come back down, what does that do for your business? Well,
for M&A activity to be strong, you need a number of things. You need supportive equity markets, which we're getting to. You need liquid debt markets, not necessarily really low interest rates, but a lot of liquidity. You need confidence about the direction of the economy, a lack of uncertainty. The biggest thing that the cloud over M&A for the last 6-9 months has been uncertainty about the economy. Are we going to have a recession or are we not going to have a recession? Is the Fed going to stop or are they not going to stop? And I've encountered a phenomenon that I've never seen before, which is when you visit with a CEO, they tell you their business is great, but they're really worried about the economy. And so if you think about it, or somebody else's business, who's going to buy a business when they think their business is really good and the other guy's or woman's isn't? So that uncertainty, which part of it is related to the Fed, part of it is related to how does the interest rate increase, the remaining flow of stimulus from the pandemic that we still have on consumers' balance sheets, and the general momentum in the economy. How do those interact, and where will we be 6 or 12 months from now in terms of real economic activity? Once we get a resolution or a clearer picture of that, we will see a pickup in activity. And the wonderful thing about our business is it's a cyclical business. It has high highs and lows, but it's a secular growth business. And if you look back since 1980, every single low has been higher than the previous low, and every single high has been higher than the previous high. I'm talking about dollar volume of activity. So, that's why Evercore is investing in talent today, because we know, the downturns have typically been 2 to 3 years. So we're a ways through that already. So we want to be ready when the market does turn.